Hey, good morning, everyone. Welcome to earningsbeats.com FAQ Friday. Today's July 10th, 2020. Got a nice crowd with us today. Really appreciate it. You got John Hopkins here. Tom Boley going to be jumping in just a minute and getting right into the meat of today's event. A couple of quick ground rules. Number one, before that, I know there's a lot of new faces in here. People just trying to figure out who we are. Thanks for taking the time to stop in. We've also got a lot of our members. Many been with us for a long time. Thank you for coming in. Hopefully you'll find this useful. It's our first time, so a bit of an experiment. This session will be recorded like every other webinar that we have. So for some reason you've got to stop to make a trade or whatever you have to do this time of day, don't worry about it. We'll be recording. Also a reminder, next Monday, with earnings season kicking in, next Monday, we've got an event that's open to the public. This is for our subscribers as well as anybody getting our Earnings Beats Digest. It's going to be a sneak preview of earnings season. That'll be Monday at 4:30. We always do a sneak preview 1 week before the members event that will be covering the earnings season, what we're seeing, some stocks that could make big moves up or down into earnings. Just this is our time. Also next Tuesday we'll have our Max Pain webinar, which is extremely popular, all about options, calls and puts that are expiring the third Friday of each month. Tom will be looking at indexes as well as some individual stocks and giving you some indication of where he thinks some of these directionally might be headed. It's just a lot of stuff coming up. Last thing I want to say before I turn over to Tom is if you are new to Earnings Beats, you can always go to our website, earningsbeats.com. Go right to the home page and you can sign up for a no-cost trial for 30 days. That'll get you into all the events that we have coming up over the next month, and there's a lot of them. And then the only other thing is you'll see a webinar special on our site, link at the top that you can click on as well, and that'll save you a lot of money over the course of a year. I just wanted to get that in. Now today, unlike other webinars, we're not going to take any questions. We've already had questions submitted ahead of time. So Tom is going to focus specifically on the questions that had the most response and other ways that you'll be able to use the service to your advantage. Anyways, with that, I'm going to go ahead, see if Tom's ready to roll here.
I am. How are you doing, John?
I'm not bad. It's Friday. You know, made it through another week.
Yeah, it's funny. You know, you were talking about max pain and options. I tell you, the NASDAQ keeps going up. We're going to have some serious option stuff to look at next week. I mean, some of these companies, I mean, you look at how far Tesla and Amazon and Netflix and some of these
my God
run. I can only imagine how many in the money call options we have on a lot of these companies. And I've been looking at the equity only put call ratio, and we've been on a daily basis now, probably for the last 4 or 5 days, down around 0.4
unreal
to 0.45, which historically, these are really low readings, meaning that a lot of folks are buying calls. And usually when you get all the masses going in one area, get ready for the reversal.
Try telling the bulls that. Oh
yeah.
Boy, it's unbelievable. All right, I'm going to go ahead and turn it over to you, my friend.
All right, sounds good. Yeah, it's going to be very interesting next week for sure. You know, you got to keep in mind, market makers, you know, there's an option strategy out there that, you know, if everyone wants to buy calls, the market makers are selling the calls. So market makers can buy the stock. So as long as these companies have good volume, you could have simply a covered call strategy for the market makers where they're buying the stock, selling the call. So there's no guarantee that it's going to come down, but we've seen it before. And sometimes the market just suddenly around options expiration Friday or shortly thereafter, we see these big moves. And historically, if you know anything about the market or have listened to me, you know that the 19th of the month of all calendar months. I would say December is the one exception because you get into the Santa Claus rally. But the other 11 months, from the 19th through about the 26th, 25th, 26th, that historically is when the market has its worst period during the calendar month. And I believe a lot of it has to do with options. So something to definitely keep an eye on. And maybe if you're not a member of Earnings Beat, you might want to come in and check out that Max Payne webinar on Tuesday. I think it'll certainly be very timely this month. All right, so as John mentioned, this is FAQ Friday. So these are a lot of the frequently asked questions. We sent out a survey to our members last week. We'll be sending this out from time to time, the survey, so that you can ask your questions. I just think this is a much more efficient way of responding to everyone in order to get your questions answered. I get a lot of emails, and with everything else that I've got going on trying to serve our members, it's really difficult to get back in touch with everyone quickly. And, you know, if you've been sending in, you know, any kind of questions, you know that our customer service is pretty darn efficient. You know, Aaron and Abby, and of course, John, throughout the years, just been awesome in terms of responding quickly to our members. And I hate the fact sometimes that I can't, but literally, if I sit down and I start answering individual questions and typing them out and, you know, trying to give, I mean, I think all of you know, I try to give some pretty lengthy responses for the most part. It's really hard. And I want to answer your questions, but it's just hard to do it through email. So we decided we were going to occasionally, periodically have an FAQ Friday. So we're going to do one this Friday. Maybe we'll do another one in a couple of weeks, and we'll just see how they go and see what kind of response we get from our members.
Hey, Tom.
Yeah.
I just want to mention one thing. I think one of the goals we have is, you know, this is the first time we're doing this one, but is to break this into sections and then break it into clips and then incorporate it at some point into our FAQ. So if people can go right in and if they have a question about scanning or a question about, you know, the chart lists, that they will be able to quickly, you know, get a good answer to what they might be searching.
Right. Got it. Yeah. And so there is a longer term strategy here too, so that we don't come in and answer the same questions when we do these events. We'll try to start building out a library. And that's something that's on our to-do list at some point down the road. All right. Now, I got a number of questions in. I'm not going to be able to get through all of them in one session, but I've got a bunch of them that I want to go over. Some of them I paraphrased because in some instances we had multiple questions about one topic. And so rather than answer the same question or similar, you know, 3 similar questions, I just kind of paraphrased, put them all together so I can just answer one. But I think this is going to provide maybe a lot of clarity to some of the questions that you all have. So let's go ahead and go through the agenda and the things that we're going to talk about today. So the questions, we broke them down into using our services, using our portfolios, using our chart lists, using our scanning strategies. And then I had a number of questions come in that were just specific trading strategies. So this is the order that we're going to try to take everything in. So let's go ahead and start with using our services. Now, if you go over to, let's see if I can pull this up for you. All right. All right, so I'm going to pull up a screen over at Earnings Beats, and this is what our members see. All right, there you go. So, you know, I guess the first question, and I thought this was pretty important to address right away. This is, you know, we've got a lot of new members, and we always have a number of new members coming on board. And so, a question that came in was, I'm a new member, and I see that you have a lot of great information on your site, but can you briefly describe the key attributes of your service to a new member? And so I'm going to kind of give you just a few minutes, 2-3 minutes of very, very quick, bringing you up to date kind of a response here. First thing that I think is really important to understand about earnings beats is that we marry great fundamentals with great technicals. Got a lot of services that look only at technicals. Got a lot of services only look at fundamentals. We look at both. We bring them both together. We initially do a ton of research to establish chart lists, and you'll see under the members here, chart list area. So you can click on that. You can go through and you can read about the different chart lists that we do. And if you're an extra member or above at Stock Charts, you can download them right into your account. But we do a lot of research to establish these chart lists, and then we use them and our members use them. We are driven by excellent earnings, relative strength, and timely trading. You probably heard our tagline, which is better timing, better trades. Honestly, I think we could probably expand it to better stocks, better timing, better trades, better results. Because I think based on everything we do, I think that would be maybe a little bit more comprehensive in terms of what we do. So in a nutshell, I'd say that those having a longer term mindset or working full time will appreciate our portfolios. And so the portfolios don't require a lot of day-to-day work. On here, you can go through and you can check out past performance. You look at each of the portfolios and kind of what they mean, you know, what the differences are. So you'll definitely want to check this page out. But these portfolios are adjusted every 3 months, so quarterly. And they include 10 leading stocks from 10 leading industry groups. And so I think as you go through here and you check out these portfolios, you'll see that we've got a lot of winners in our portfolios. And there's a reason why we're outperforming the S&P 500, because we stick with those winners. Now, because they're adjusted every 90 days, your money is generally going to be invested in leaders all the time. And I believe our results speak for themselves. I mean, if we go back and take a look, well, I mean, right here, I was going to go to our other page, but you can see this has actually been updated through yesterday's close. And since the inception of these various portfolios, you can see how we've done. 117.5%. So that's more than a doubling of your money in the model portfolio since November 19th. And the S&P 500 is up 17% during the same period. We're now up 100 percentage points above the S&P 500 since November 19th, 2018. I think that is something that everyone at Earnings Beats is really proud of. And I know we've gotten a lot of great feedback from our members on that. But hey, the aggressive portfolio, which has just been out a little over a year, is up 45.3% versus 10%. The income portfolio, actually until one quarter, not this quarter, but the quarter before, this one was leading, but actually pulled back. It's leading again this quarter, so it's starting to make up ground, but it's pretty close to the S&P. And then we just started a new one, the Strong AD portfolio, and you can see that up more than 10 percentage points above the S&P. And what's interesting here is that we started it at a rough time. And after, I think it was on June 8th, the Strong AD portfolio was 11 percentage points behind the S&P 500. So in 1 month, it's gone from being 11 percentage points below to 10 percentage points above. That's a 21 percentage point swing in the last month. So this portfolio has certainly been cooking with gas as well. If you're more of a swing trader, though, then we work, the work we do to provide chart lists for strong earnings, strong accumulation distribution, strong future earnings, short squeeze opportunities, all of those make sense. So again, back to this chart list page, you want to check that out if you're more of a swing trader. I also provide a daily market report. So here you can see the EB daily market report. This will be mailed to you, but if for some reason you're not seeing it or you haven't gotten it, you can come into the website and get it. I update this right at the same time that I'm sending it out to everyone. So if you haven't seen it and you're wondering maybe if the mail's slow or whatever, you can always come in here and check it out. But the daily market report goes out to our members, and it's normally delivered each day that the market is open, and normally between noon and 2 o'clock. Sometimes it's a little later. Sometimes I just want to see how the market's doing later into the afternoon before I start writing. So the timing can vary. But I'd like to think that this DMR provides guidance while also attempting to uncover and share potential trading opportunities with those who have the time and inclination to pursue them. So, you know, here just talking about a couple of stocks, Amazon and Netflix, they don't seem to want to go down, but they do have negative divergences in play. So it could be, you know, stocks that we like that maybe are breaking out. It could also be stocks like this that maybe are just showing that they could be a little toppy, especially as options expiration approaches. Another feature that we've recently added is scanning strategies. So under scanning strategies, you'll see a number of different strategies and the syntax that goes along with that. And we'll be talking about this a little bit more in some other specific questions. Now, there is one caveat to all of this: the chart lists, the scanning strategies, these portfolios, all of this stuff. If you have a Stock Charts Extra membership or above, you can download and use this all in your account at Stock Charts, which is incredibly efficient. We do all the homework. We provide you with a lot of information to make better trades, and you simply take all of our research and download it into your account in seconds. So that's kind of the 3-minute or maybe 4-minute version of how our services, I think, can work in for a new member when you first come in. Those are some of the things that I would be focusing on. All right, another question that came in about our service, or maybe about what I do personally, said, as a short-term trader, what is your pre-market routine? Well, I have to maybe say that it's been changed over the last year, because I used to be a pretty active trader, and I still trade, but it's much harder since I came back to earnings beats from Stock Charts. I mean, when I was at Stock Charts, I would write my blog, be done at 9 a.m., and then I was free basically to go do what I wanted to do. I did have a noon show. I think that was Market Watchers Live. Yeah, I think it was Market Watchers. So I had a show around noon, but literally when I finished my blog at 9 o'clock every morning, I was available to go do whatever I wanted to do to get ready to do my own trading. But that all changed last year when I came back to earnings beats effective September 15th of last year. We began providing a lot of information, and it's been growing. The information that we provide, the research that we do has been growing. So I have a little bit, I'll kind of show you some of the things that I do, but you have to keep in mind now I'm doing shows from 9 to 9:30, Monday through Thursday. And I have to prep for those shows. So my routine is not what it used to be. I don't have the time. And so as a result of not having the time, I've had to change my trading philosophy, and I hold on to stocks a little bit longer. I would say that I'm more of a, I wouldn't say long-term, but longer-term swing trader than what I used to be. I did a lot more trades where I would be out within, 2, 3, 4 days. And now I'd say it's probably more like 2, 3, 4 weeks. So some of that changed, but let me tell you a few things that I do. So getting back to your question. First thing is we do our homework. So come over here, let's just take a look at the Strong Earnings ChartList. I mean, this Strong Earnings ChartList isn't done every morning. This is not a pre-market routine, but this is something that gets updated every week or two as earnings season picks up, probably every week to 10 days. When earnings season's a little slower, maybe every 2, 3 weeks. But you can see these are all the companies that are on our Strong Earnings ChartList. And they're all annotated with key support levels at the time that they were added to the chart list. And so this is part of that pre-market routine, is simply just going in and checking out some of the Strong Earnings charts, maybe running scans against it and so forth. I review all the major indices on daily and hourly charts. So I'm going to pull up the S&P 500. I mean, I'm probably already going to be pretty darn familiar with it anyway, but I'm gonna look at it on the daily basis. Just, get a sense. All right, PPOs above the center line. I'm still feeling pretty good about this being in an uptrend. You can see the market actually has now gone positive today. But then if you look at the hourly, sometimes it'll show some negative divergences. Now on the S&P here currently, that we're right back down to the center line, which is actually pretty good. We've pulled back. The NASDAQ 100 has been going up, but not the S&P. So I'm going to look at all the various indices to get a sense of what works for me in terms of, do we have uptrends? Do we have downtrends? Just trying to get my focus on, am I a buyer? Am I an aggressive buyer? Am I cautious because of negative divergences? When I look at the NASDAQ 100 and I see higher prices, lower PPO, that makes me a little nervous. The time of the month, the historical, knowing some of the historical tendencies, all of these things are going through my head. I'm also going to look over at Zack's. So let me pull up Zack's here. Usually when I'm going in, to study the market for that particular day, I usually want to know, and this is what I do prepping for my shows, is I come over and I look at the earnings calendar on Zack's. One of the things I do every single morning. So today, only 3 earnings reports. You can see the earnings reports here. But yeah, I mean, I want to be aware. I want to know what is going on with these, with companies and so forth. The other thing that I do is I go to briefing. I don't think I have it saved, but let's just pull up Google, and then I'll just type in briefing in play, which gives you a lot of really good information. I pretty picky when it comes to news. I want to get my news from places where I'm getting the news. I don't want to get my news from places where I'm getting someone's opinion of the news. Big difference. So I find that briefing, looking through a lot of this and just seeing the different stories, I normally would just come through, and if I see a ticker symbol maybe that I'm interested in, or something that just kind of strikes, looking at these analyst comments, sometimes they do these summaries before the market opens. That gives you a pretty good sense of what's taking place. And if I see something I like, okay, Netflix got their target raised. So if I might look at that chart. I mean, I already know what Netflix chart looks like, but I might, if I see a story, I'll go to the chart, take a look, and see if it's maybe at a key area of resistance. Maybe we're going to get a breakout with some news like that. So really, that's what I'm doing. I'm going to, the market's going to open. I'm going to start, run my early morning scans, which is my high volume scan, usually around 9:45, 10 o'clock, just to get a sense of where the volume is coming in. And I'll run those high volume scans against my chart lists, not against the overall market. I want to trade my chart list. That's where I've done my homework. Those are the companies I'm most familiar with, most comfortable with, have the most confidence in. And so I'm going to run my scans against those chart lists. Afternoons, I typically will run like a downtrend reversal scan, which is on the website. So if I come back over here and we go into the scanning strategies, one thing I like to do toward the end of the day is this downtrend reversal, which is a pullback scan. These are companies that have been going down, rather than, trying to find companies that, take off and are just going up day after day. I don't really like to chase. If I'm not already in it, I don't want to chase, because probably about the time I get in, you're going to get the pullback. But you can see here's the syntax. You can take this right over to stock charts, copy it, drop it into a scan, add the chart list that you want to scan against, and boom, literally in a couple seconds, you'll have any companies that fit this criteria, which essentially is companies that have been going down for 5 days in a row. The daily high is lower 5 days in a row, and then today's daily high is greater than the prior day. So you've kind of picture in your mind, downtrend, 5 days, and then all of a sudden we're getting a move up. Well, if that's happening on one of the stocks on one of our chart lists, that can be pretty critical, because I want to catch it as it's reversing. So I think that's a great scan. And so that's basically it. I know I probably went a little bit longer, maybe 5-6 minutes, but that's kind of the routine that I would go through. I'm looking for opportunities. Questions have come in, when do you like to buy or when do you like to sell? Is there a time of the day that makes more sense to you to buy or sell? Well, mornings, I always say mornings are for amateurs, afternoons are for pros. So if I'm looking to sell, and sometimes, stock's been going up and I think the market's getting toppy, a lot of times amateurs are rushing in the morning in the final stages of an uptrend, and that gives me an opportunity to exit, to get out. And then once you start seeing, movement to the downside, and you trade down for a few days, normally you'll see the opposite. Toward the end of a downtrend, you'll see the market reverse, start to finish higher at the end of the day. So again, you can run the downtrend reversal scan in the afternoon. And so a lot of times I'll be buying in the afternoon. All right. Do you intend to resume specific detailed trade alerts? We've got, actually, I think we may have taken it off because we haven't done this in a while. For those of you who are new, we did occasionally send out an individual stock and say, okay, it's a trade alert, buy at this price, sell at this price, or, this is our target, this is our stop area. And it was educational. But honestly, because my role has changed so much here at Earnings Beats, and I'm doing so much research, I honestly feel like my time is better spent on the research side of things, doing these shows, writing the daily market report, and providing what I think is really good guidance to our members with potential trade candidates within the daily market report, on my shows, in my blogs. I mean, I give so many possible trade ideas. One of the problems I have with the trade alert is that it goes out to all of our members, and all of our members don't have the same mindset as far as trading goes. Some are long-term, some want to be safe, some want to, shoot for the stars, give me that 72-cent stock. Some are, managing their portfolio in retirement, where they really are trying to make sure that they don't, give too much capital away. You've got others maybe who are younger and have a lot of extra money, and they kind of looking at this as maybe a form of being at a casino in Las Vegas. That's not the way I look at it, but I'm just saying, everyone's mindset is different in how they approach trading. And so one of the problems I always had with trade alerts is that you're sending out one trade to everybody in the universe who all have different opinions. And if somebody that is, very, risk averse gets into a position and the stock falls 10, 12% in a day or two, that can be, pretty emotional type of a trading loss. So it just comes down to, I think what we provide is good. I mean, I think it's great. I think we give a lot of information to our members. We give so much with the chart list and all the research we do and the scanning tools, the syntax that we provide. I think we give everyone so many opportunities to find good trades. I don't know that the trade alerts add much value to our service, to be honest. And because my own trading, has changed in terms of not trading as often, I think that, and the reason I'm not is I can't follow it. I can't follow trades the way I used to, because I am doing a lot of these other things for our members and a lot of the research and so forth. So doing something that was much more active trading, I just don't think really fits in to what we're trying to accomplish at Earnings Beats now. Last question on using our services. This was a question that came in. How would a long-term investor use your service? That's a good question. Number one, I think the daily market report is going to keep you up to date on what we're thinking about the market. And I think as a long-term investor, you really want to know, are we in a secular bull market or are we in a secular bear market? That doesn't change very often. But being aware of maybe short-term pullbacks that could occur maybe gives you a little bit more confidence just to hold through some of the turbulence that we've seen. I think, perfect example has been the trade war and the pandemic. I never gave up on my belief that we were in a secular bull market. That's pretty important from a long-term investor standpoint. Because if you're going into a secular bear market like we had 2007 to 2009, well, really 2000 to 2013, until we broke out in 2013 above that double top on the S&P 500. And I can show you what I'm talking about. Let's pull up the S&P 500 and go back monthly. We'll need to go back even more than 15 years. Let's just go back, 40 years. But when you're in a secular bear market, that's a much different animal as a long-term investor than a secular bull market. You see the difference? You see the secular bull market in the 80s and 90s? Secular bear markets are long-term going nowhere markets. As a long-term investor, I'm not sure that, this is what's going to happen is you're going to be a long-term investor. But then when you go through these periods, you're going to want to get out because it's going to panic. You're going to think we're heading for the Great Depression. The financial services industry was crushed back in 2008. And it did look like maybe it was going to be a depression. And it's hard to keep that mentality of being bullish and holding on when you're in a secular bear market. Secular bull markets are different, though. These pullbacks, yeah, they're scary, but they're very short-lived. Very different than what we saw before. So I think that's where you're going to get some value. I think also these portfolios, they're really designed more for long-term investors. And I've got a question. I've got questions about portfolios I'm going to get into in a minute, so I'll address it there. Actually, let me just go ahead and address it here so that we have this answered as part of this question. The portfolios, you do make trades every 90 days, but that's it. You're in to 10 leading stocks within 10 leading industries, and you don't do anything with them for 90 days. So it basically is buy and hold. The only difference between buy and hold long-term and buy and hold with our portfolios is the timing. I mean, we do it, we change them every 90 days. And actually, I think it's a great way for long-term buy and holders to benefit from relative strength. Your money is always working in areas that are working in the market. Now, you know, past performance never guarantees future results, but if you like the concept of being in 10 leading stocks in 10 leading industries and changing every 90 days to make sure you stay that way, I think this is very appealing to a long-term buy and holder. All right, let's move on to using our portfolios. How do you select the portfolios? Well, I can tell you 3 of the 4 portfolios. We've got the model, the aggressive, the income, and the strong AD portfolio, which is strong accumulation distribution portfolio. 3 of them, model, aggressive, and income, are all based on, they have to be on the Strong Earnings chart list to get into that portfolio. So it all starts with, you know, being on one of those lists. And I might even go back a step further and say really where it starts is looking at the relative strength of our industries and our sectors. So here is our industry group relative strength chart list. Now I look at this chart, and this is computer services relative to the S&P 500. Look at it, it's going straight down. It's at a 52-week low. Is this something I would want in our portfolios? No, I'm trying to outperform the S&P 500. I can't do that with a group that's just showing this long-term downtrend. So I'm going to have to find a great stock within an industry like this in order to even keep up with the S&P, let alone beat it. So I'm going to go through all 104 industry groups on a relative basis, and I'm going to find the strongest. And when I say the strongest, take a look at software. So here's software. See the difference? Software is a group you want to be part of. If you're trying to beat the S&P 500, I'm going to say it's a lot easier to do it with software than it is to do it with computer services. Now, 3 months from now, maybe this changes. Maybe all of a sudden computer services catches fire and we've got, you know, something we have to reconsider. But right now, I think that it's a good call. You know, and you saw a little bit of relative strength here, but the configuration I like is relative strength above the 20, above the 50, with the relative PPO above 0. That to me is the definition of a strong industry group. So I do this with industries. I also do it with sectors. And then literally after and you can see here's technology. Obviously you want to be represented by technology. You definitely want to be represented by consumer discretionary, communication services, the same. But how about energy? You want an energy stock in your portfolios? I'm going to say no. This has been going on now for 8-9 years, by the way. This isn't just the last 3 years. So, and I've, you know, for the last 7 quarters, I've been asked, well, you know, why don't you include energy? Well, this is the reason. We started back in November of 2018. Look at what energy's been doing relative to the S&P 500. The only energy stocks we've had have been renewable energy. And I think we did have energy for 1 quarter, and I don't remember when it was. I'm trying to think of a stock. Anyway, I think you get the point. We're trying in our portfolios to put the best stocks within the best industry groups and make sure we stay somewhat diversified. We don't want 10 software stocks because if software all of a sudden has a bad quarter, our portfolio is going to get crushed. So we do try to diversify, but we're sticking with strength. All right, next question. Why are no stops used on portfolios? Well, the main reason is, honestly, we want to keep things simple. I think probably the most appealing part to these portfolios is that you simply buy on May 19th and you sell on August 19th and you replace them with these stocks on August 19th and you don't do anything until November 19th. It literally is buy and hold, except that you are adjusting your portfolios every 3 months. But from there then on, you don't do anything. And I understand the question, and as a trader, I completely understand why you would maybe want to have a stop in play. But my answer to you would be that this is not a trade. This isn't a trading portfolio. It's a holding portfolio for 90 days. So it's not buy and hold forever, but it's buy and hold for 90 days with the idea that, yes, you're going to probably have a stock or two that maybe pulls back and, loses support, that as a trade, you might use a stop and get out. But again, this is not a trade. The other thing that we have found with these portfolios is that when the market drops, just like we saw back in February, if I pull up the S&P 500, February and March, we had a huge drop. Our portfolios got hit too. It wasn't like we're immune. It's not like the market's going to do this and our portfolios are going to go up. We're going to go down with them. But what we have found is that when the market begins rebounding, money goes back to the leaders first. And so every time we've had these big drops, our portfolios, at least to date, have rallied back much faster than the benchmark index. And so that is one of the reasons why we don't want to use stops, because when the market rebounds, the stocks that we have in those portfolios, for the most part, are going to be stocks that Wall Street's going to gravitate toward. Okay, how do you determine which industry groups are showing relative strength? Well, that is right off of that relative strength industry group chart list. So we go into computer services, no. Semiconductors, yes, like that one. Software, yes. And again, it's the configuration. I like relative price action above the relative 20 week, above the relative 50-week moving average, and the relative PPO needs to be in positive territory. That's the perfect setup for me. Look at electronic equipment. See, this one started to look good, but just like stocks, they move up sometimes, for a brief period and they roll back over. You see the history? You can't trust, you get 3 or 4 good months out of this group and then you can't trust it and it falls back apart. And the PPO pretty much tells us that, it doesn't stay positive very long. And so we keep going down through the list. Here's computer hardware. Yes. Here's the electrical components and equipment. No, I don't want to be part of this one. Telecom. No, it was strong for quite a while, but this turned negative and it's been negative for a while now. And so we just go, those were the 7 industry groups within the technology area, but we have all of those on this particular chart list, which, by the way, if you're an annual member and you write to us at support@earningsbeats.com, we will send you this chart list and you can download it into your account at Stock Charts, so long as you have at least an extra membership at Stock Charts. Okay, last question on using our portfolios. Do you think your current portfolios will hold up during earnings season, given the potential of very bad earnings? Well, we've got leaders. So the whole concept is that Wall Street sends their analysts out to companies and they ask management teams what's going on in their business. They get a lot of information that you and I can't get. I can't call Apple and say, I'd like to set up a meeting with the management team. But what I can do is I can follow what's going on in the charts, which in essence becomes my research team. And so when I see companies being accumulated and becoming leaders, I can make a pretty good assumption that Wall Street likes what they're hearing from those companies. And they're going back to their offices and they're buying stocks. They're buying stocks for their clients and, within their companies. And lo and behold, maybe shortly thereafter, you start seeing estimates being revised higher. You see targets being raised. But all of this occurs for the most part with stocks that are already in uptrends. So that's the point of these portfolios, is finding stocks that Wall Street likes. I believe just about all of our stocks in our portfolios are going to report very strong results. And that's been, for the most part, our history. All right, let's move on. Using our chart lists. So how do you determine, and again, if you're in the Earnings Beats website, we do have, under the members area, chart lists. So you can go in, we've got a brief video, explains a little bit about how you can use this, how you can download these chart lists and so forth, and how you can use our service with respect to the chart list. But this specific question is, how do you determine where to place your horizontal support and resistance lines on your charts. So I thought what I would do is just kind of show you on the Strong Earnings chart list, because that's where these, I'm just going to haphazardly, I'm just going to flip down and just pick one. PBH, there we go. So how do you determine where to put these? And sometimes it's easy, sometimes it's not. Especially with the pandemic, because when you're coming down straight down and then you're going straight back up, it's hard to find key support areas. But what I've done here with PBH is I've looked, we had a huge move up, and I try to look back to see where prior lows were on pullbacks, because that's where buyers stepped back in. So a lot of times you're going to see these coincide with some prior support lows, price support lows. So PBH here, very simple. There's a support level. Here's another one. Now this is where we gapped down big time at the open from about 36.70. Looks like we gapped all the way back down to about 35.25, and then rallied off of that and kept moving up. Notice when we pulled back, we got very close intraday to this level as well. And the day before, we were also at this level. So I think this is providing pretty good support. And look, when we went back just the last couple of weeks, we went right down to this 35 area and turned and came right back up. That was a $2 move off support in one day. But now it seems to be stuck between these two support levels, and we're trying to bounce off that 35.25 area right now. So the whole point of these support levels, by the way, is that when you do pull back into this area, and especially if you pull back intraday below and then come back up above, that is a way for market makers to accumulate shares for institutional investors. So it's important to watch these support levels. Now, keep in mind that a lot of times these support levels go in at the time that they're added to this chart list, which a lot of times around earnings. So if PBH, for instance, reported earnings sometime in April, I would probably have been drawing these lines here. Well, you can see later on we make another move to the upside. So sometimes these support levels will become somewhat obsolete as you get further and further into an earnings season. To go back and annotate all of these charts every time we update the chart list would be it's just not possible from a timing standpoint, because right now we have 325 charts. So if I send out a new chart list in another week, to go back and annotate 325 prior charts in addition to everything I am adding would make it very, very difficult. So keep that in mind as you're looking at the chart list and you go further back. The ones at the very top of this list are the ones that reported the longest ago. So this would have been the beginning of April probably when Fastenal reported. Whereas the bottom of the chart, like FedEx just reported, I think July 1st. So you pull up FedEx and you can see there was the gap up right at the beginning of July. So here, support levels, well, there was your prior high. When a stock first gaps up, and I just wrote about this in a Trading Places blog article earlier, but when I see a gap up with earnings, I like to see what happens after that gap up, because that tells me a lot about what a stock is likely to do in terms of its short-term trading direction. So when I see a gap up and a failure, I start thinking more about a little bit more of a pullback. And so that's why I'm looking at this support area and maybe even gap support. That would be a complete gap fill to go all the way back down to 140. That was a good report. I don't know if we'll go all the way to 140, but if we were to get down close to that 148, 150 area, that would be interesting. So all of these charts, it's just, it's in the eye of the beholder. And I know sometimes you probably look at this and you might think, well, it's more in the eye of the beer holder, because you can't quite figure out why I'm putting support lines at a certain level. And some of them are much easier than others. Some of them are they just pop right out to me. Like to me, this is pretty simple. That prior high and this gap support, that is really easy with earnings. Sometimes even that PBH I showed you is a little bit more of a cluttered chart. So support is a little bit more judgmental and not quite as easily seen. All right, would you consider identifying strong and weak charts from your chart lists using RRG charts? First of all, RRG charts were created by my good friend Julius de Kempenaar. Julius is really sharp, does some great work with the RRG charts. You know, for us, because we use the price relative and it's on all of our charts already, I mean, this is what all of our charts on our chart list look like. So if we're looking at the industry group that a stock is in, so FedEx, for instance, is in the delivery services group. Delivery services is trending higher. FedEx relative to delivery services is trending higher. FedEx relative to the S&P just broke to about an 8-month relative high. And delivery services relative to the S&P 500 is now on the rise and been rising for about 2 months. So I can look at this and I can get all of the relative strength information that I need or that I want right here from this chart. So I don't have any plans of adding RRG, but if you like to use RRG, I mean, it's a great tool. You know, well, I'm not going to go into any more information on using the RRG because it's not part of our service, but I think that's a great tool at Stock Charts. And like I said, Julius is a great friend. I've looked at the RRGs and used the RRGs on my shows. I just don't know how it would be a really good fit in what we're doing here at Stock or at Earnings Beats. Okay, next up, this was a great question. The stock market is forward-looking. So wouldn't the Strong Earnings chart list be backward-looking? Wouldn't using Zack's ranking system, which is forward-based, be a better tool? And I've got two responses to this. Number one, it's interesting that you bring this question up because I am actually looking at a new chart list for us to share with all of our members. I just started doing some research, probably work a little bit with Aaron, and we'll get something going here soon, but it's based on forward guidance. It's a new chart list that is only looking at future guidance. So that's something that I think will answer your question there. But for me, no, I don't believe looking at the Strong Earnings chart list is looking in the rearview mirror. And I'll tell you why. First of all, any company that beats management estimate, or any company that comes out with and beats the estimates that are out there on Wall Street, is saying two things to Wall Street. Number one, it's saying that we under promise and over deliver, which is a lot better than over promising and under delivering. Wall Street's going to have a lot more confidence when you under promise and over deliver. Why is that important? Because getting back to this question, future earnings is what drives valuations. Now, if you have two companies, one comes out and they both come out and they raise revenue and earnings per share guidance. But one of those companies last quarter missed their estimates and the other company beat their estimates. Which one are you going to believe when they talk about raising their guidance? You're going to believe the company that just missed? They just missed the guidance they provided before, but now we're going to believe what they're going to do going forward. They're going to raise their guidance going forward, and we're supposed to say, okay, we completely trust that you're going to do it. We know you didn't do it last quarter. You couldn't beat your numbers, but this time we're supposed to agree and go along with it. I think that when companies beat, and this comes back, I know as a former practicing CPA, I had a responsibility to banks and to others, when I would audit financial companies. And when companies had budgets and they didn't meet them, or they told me early in the year, oh, this is going to be a great year, and then we come in to do the audit and it was a horrible year, it's definitely a different, a different look, a different spin on the management. And if I have to do a valuation of that company, and that company comes and tells me, listen, we're going to do great the next 3 or 4 years, here's our earnings estimates. And I'm going to say, yeah, but you just budgeted last year and you couldn't come up anywhere near the budget you just gave. Why are you going to grow 40% the next 5 years when you couldn't grow 10% the last 3? And so that's the issues that I think Wall Street deals with. So I think it's really important for companies to beat top and bottom line. I think it says something about the competency of their management, the execution of their business plan, and those are the types of companies that I feel confident trading. I think since I started doing this back in 2013, following our Strong Earnings chart list, I can tell you, and I haven't gone back and tracked it, but I can tell you I've had very, very few instances where I'm holding a stock and companies come out and warn. Maybe I've just been lucky, but I think part of it is our strategy and the way we look at our stocks. So yes, I think looking at future earnings is always important, but I don't think that you should dismiss the strong earnings chart list. All right, last one I have on our chart list is the strong future earnings chart list. And this is one that we came up with recently. These are companies that are showing great relative strength, but they didn't beat last quarter. Okay, now remember, we just went through the pandemic. So a lot of companies, good companies, struggled, but have since started recovering. And so we want to be aware of those companies. And these are companies at Wall Street saying, hey, they're going to come out with some big numbers this quarter. That's why they're relative strength leaders. So with all of our focus being on companies that have reported strong results, we wanted to get a chart list that maybe focused on just the technicals to lead us. So there's no requirement to beat earnings to be on that list, okay? So the SFECL, Strong Future Earnings Chart List, question that came in says, seems like these should produce great earnings, but what would be the best way to pare down the list to a more manageable portfolio? Well, currently we have 207 stocks on this list. So I understand the question. You know, you've got this chart list, 207 great companies. What do I do with it? All right, well, the first thing I would do is pull up the Strong Future Earnings Chart List. And if you already have a sense of which industry groups are strong, remember, you know, we can go in, we've got that industry group relative strength chart list, okay, which tells us which industry groups are outperforming the S&P 500. Well, if you go into your Strong Future Earnings and you click on View All and then Summary, this is the list of all the stocks. By the way, ZYXI, this is in our model portfolio. Stock's up 14% today. But as you look down this list, you can see that they have sectors and industries. Now, if you pull up the summary and it doesn't show all this information, you got to go over here on the columns and make sure you've got everything checked that you want on here. So if I take scooter, industry, and sector off, you'll be looking, you'll be saying, hey, I don't have a scooter. I don't have my sector. Where's the industry group? Mine don't show that. Well, it's in the columns. Make sure it's checked off. So you can customize this. All right, so then the question becomes, all right, well, how about the scooter score? I mean, that's a relative strength tool. Well, here you go. Here are some stocks that look really good. Now, I wouldn't just pick the top 10 because you're going to have about 7 biotech stocks. So that doesn't really make a whole lot of sense. But what you can do is once you sort by scooter, sort by industry. And then I think you can even sort by sector. So it should come up in sector order, industry order, and then scooter order. I think it preserves those orders just like that. Yeah, so discretionary. I can tell you internet stocks. And this whole list was built based on the fact that these companies were in the best industry groups. So that's why you're only going to see internet, broadline retail, specialty retail, toys. But if you wanted to say, hey, what's the best internet stock? Well, right now, according to the scooter, it's Netflix. What's the best broadline retailer? Amazon. What's the best specialty retailers? Overstock. Best toy, Glue Mobile. You know, some of them are small cap, some of them are large cap. Specialty finance, Workhorse. Well, that one you better be ready for a wild ride. Or MSCI. This is a large cap, so you can kind of look and see, you know, how it fits. So anyway, long answer, but you can kind of get the gist of it here. Start with that Strong Future Earnings Chart List and then use the tools at Stock Charts to be able to manipulate this. Run scans if there's something particular that you're looking for. You might say, hey, you know what, yeah, these are good, but Netflix has been going up every day. I don't want to jump into that. Maybe run a scan against this and say, give me every stock that has a scooter above 90, but has an RSI below 60. So you know you're not getting a stock that's hugely overbought. I mean, there's different ways to approach it, but great question. Hopefully that answers it. Let's move on to using our scanning strategies. Just a few questions here. First question is, and I'll go back to show you the scanning strategies page of our website. So here are different scans that we like to run. And again, you can just take these and you can just copy the scan syntax, take it over to Stock Charts, drop it in, add the chart list that you want to run it against, and then you're good to go. You'll be running a scan. You'll be a scanning genius in about 10 seconds. Any suggestions or limitations on scans for cryptocurrencies or Bitcoin? Hold on one second. All right. Well, I guess my answer to that question is pretty simple. You can't be an expert in everything. You know, I get questions sometimes about ETFs, you know, foreign ETFs. What do you think about the EWG tracking Germany? What do you think about the Russian ETF? There's so much that goes into that. Fundamentally, I can't even begin to tell you. I don't understand all the laws, all the politics, everything that goes into trading in different parts of the world. That's not my area of expertise. And so I'm not going to try to venture off into that. And then the areas of expertise that I actually have would suffer. I wouldn't have the time to put together research like I do on the US stocks. So when a question comes up like that on cryptos, I'm not interested. It's just, I'm not familiar with it. I just don't have expertise in that area. So I don't look for it. I don't buy it. I don't trade it. So I have no real answer. Allergies can be rough sometimes. All right. So which scans do you use the majority of the time? Well, from our scanning page on our website, you can see them. I mean, they're listed. Scan 1, 2, 3, 4, and 5. Those are the 5. Now, sometimes I'll run other scans, but this is, a lot of my scans are pretty simple. I've already got my chart lists. So I'm looking for certain things within those chart lists. And that's where my trades come from. So you're looking at them when you go into our website and go into the scanning strategies. For the most part, you're looking at them. Now, what I might do sometimes, and this is another question, how would you modify your scans for varying market conditions? Well, right now, you know, if I was going to run a scan, say on a 52-week high, I'm going to get a lot of stocks like Netflix and Amazon and companies that just have been going up day after day after day, but they have scooter scores at 99. So what I might do is run this scan just like this against my Strong Earnings chart list, but I might say, give me the stocks scooter 90 and below, you know, scooter below 90. And the way you would do that is you would just take this. I'll just give you an example. All right, so there's the 52-week high scan. I'm copying it. Watch how quick this is. I go over to stock charts, your dashboard, go down to your scans, new scan. Don't need this because I'm going to scan against the chart list. So let's just get rid of that. Paste. There's the 52-week high scan. Now I'm going to go in and find a chart list. So let's run it against the 52-week, or excuse me, against the Strong Earnings chart list. Add that. There you can see it's been added. And the reason I don't put the chart list in the scan syntax is that this favorites list depends on every individual's stock charts count. So my Strong Earnings could come up as favorite list 55, but in your account, it might be list 82. Okay. So that's why I don't include the actual wording for the chart list in the scan syntax. So you have to add that. But if I wanted to adjust it, I could come over here and say, okay, give me a scooter. Now the default is scooter greater than 90, but I actually want scooter less than 90. So this will just give me stocks that aren't the ones that we're seeing breaking out every single day. All right, I checked my syntax. Everything's good to go. It says it right here, syntax is correct. So I've run the scan. And on the scan, I get 2. So I've got Conagra and McCormick, 2 food staples companies. These are the only ones under 90, but they might fit your parameters. Now, if you want to go back and just remove that and just say, okay, give me all of them. Forget about the scooter score. I just want to know what all of them are. There's 25 of them. So 23 of them are going to be over 90, or 22 of them. One of them doesn't even have a scooter score. So some stocks at stock charts don't have scooters. But there's those two that we looked at that were under 90. So there's so many different ways, but you can see quickly which ones are breaking out to new highs. So that's how I would use the scans and how I would modify. All right, let's move on. The final area of this Q&A is going to be specific trading strategies. And there are a lot of questions here, and I'll try to do this best I can. I didn't have time to really get in and find some specific examples for each of these questions, but I can at least talk about them. So the first question, again, under specific trading strategies, first question, what do you consider when setting your exit strategy? All right, I'm just going to pull NVIDIA up. We'll use NVIDIA as an example. Now, because we're doing so much more research and I'm not trading as actively, I tend to hold on to stocks. And one thing that I absolutely love is a stock that's trending above its rising 20-day moving average. And if you look at NVIDIA as an example, this stock, if you got in when it went through the 20-day, or maybe when it broke out, maybe even say, when it broke out above the February high, you're like, okay, we got in on this breakout. You're getting in at 325, let's say. If you notice since then, we're now at 422 and we've never closed below the 20-day moving average. So that's an exit strategy. Just simply waiting. And as long as this stock keeps trending up, you just hold it. Now, what's probably going to happen at some point, because you know what happens to these stocks, they come down so much faster than they go up. And so, at some point, there's going to be a reckoning with NVIDIA and with all these NASDAQ stocks that have been going so well. But I think, using something that is disciplined, I think is really important. Some will say, well, how about, IBD uses 8% on their pullback? Should I have a trailing stop of 8%? Well, the problem with the trailing stop of 8% is that NVIDIA, if you're trend trading this and it's up to 422 now, 8% would be roughly what, $32? So that would take you back down to 390. 390, you get stopped out when the 20 days at 384. So I'd be getting stopped out before I even get a 20-day test. I don't like just random stops, X%, $4. To me, it just doesn't make any sense. I want to look for breakout levels. For instance, Netflix went up to 380 and came back down to about 355 before going back up and breaking above 380. I think we got pretty good price support around 380, and we got the 20-day at 384. So 422, I mean, if you want to capture profits, that's fine, but I don't see anything on this chart that tells me to sell. So, I mean, setting what constitutes an exit strategy really depends on each individual person, your own goals. I believe you should be setting your exit strategy when you enter the position. Sometimes, and I get other questions about selling, and a lot of times it's after the purchase has been made. And I think that's a mistake. I think buying a stock, especially if it starts going down, then your emotions start getting a hold of you. And then you begin to think about selling for an emotional reason. And if you trade with emotion, if you're buying, chasing because the emotions are getting to you, seeing the stock, Netflix been up 10 days in a row, I'm going to go buy it now, or excuse me, NVIDIA, I'm going to go buy it now. That's going to get you in trouble. Or if you, get in and then the stock starts going down, it's down 5 days in a row, but it's still above the 20-day, but you just don't want to take the chance of any more pain. A lot of times you're selling, market makers are buying. You're on the wrong side of the trade. So, that's a really difficult question to answer specifically. I would just say tune into the blogs, tune into the shows, tune into the DMR every day, because I do talk about selling from time to time in those, using those different avenues. Next, our next question, is a drop beneath the 50-day simple moving average a signal to exit? Well, I think that, again, depends on your own style. If you're in if I was more concerned about the overall market and we pull back below the 50, absolutely I would be out, because in a downtrending market, a lot of times the stock will stay below the 50-day. I mean, there's no doubt that a stock that's above a rising 50-day moving average is healthier than a stock below the 50-day moving average. No doubt. No question in my mind. That's a pretty good statement. Would I sell every time my stock goes below the 50-day? No. If a stock has been sideways consolidating for a while, what you'll see is the 50-day come up from underneath. And during periods of consolidation, sometimes you go up and down below moving averages quite often, but you don't lose price support. And I'm trying to think of a stock recently that maybe, I wonder if AMD did that. Yeah, perfect example. So AMD, great stock, pulls back, goes back up, little cup, sideways consolidates. You see these moves down below the 50-day? I actually wrote about this AMD in the daily market report this day. I remember that tail. We went down below 50. You see these prior lows? We came back up. We put in that hammer right at 50. Look at where we went. This was a real-time chart that I put in the daily market report, and I'm pretty sure it was that day that went right up and hit the resistance level now at 57.5. That could have been a 15% trade, but when you're getting in below the 50-day. That, again, under that theory, below the 50-day being a bad signal, you wouldn't have bought. But price support tells me it's a great time to buy. So I've got a kind of a hierarchy of what I look for and what's most important to what's maybe less important. Everything on my charts are important. So the moving averages, the PPO, the accumulation distribution, when I have the RSI, volume, all of these things are important, but some are more important than others. And for me, the most important criteria when I trade is price volume, that combination, price volume. So when I see a move like this and I get the breakdown intraday, but come back up and hold price support, that to me is a great time to buy. All right. Should I sell when the PPO drops beneath centerline support? Well, look at this. AMD is a great example here. We dropped below centerline support. We did not lose price support. The MACD, the PPO, these are formulas. It's just my personal belief, but I think these formulas, they give us some good indications, but they are just formulas. You put the numbers in and they spit out a line for you. They can give us great information and great clues, but I still think the most important clue is your price support, your price resistance, the volume, false breakdowns versus real breakdowns, false breakouts versus real breakouts. Those are the things that matter the most to me in trading. PPOs, moving averages, those are things that I just use as tools to help me manage my trades. Next question. When you hit your target, do you sell your entire position? Well, it depends again on this. It depends on market conditions. If I'm in a market where I believe we're just going sideways, or maybe even, things are much more nervous, maybe we're downtrending, think back to February, when we bounced back in February, or maybe even when we bounced earlier in March. In March and April, when we were bouncing, I was not buying and holding. I was trading. I was trying to find a stock. If I could get a pop, 10, 12%, I was getting back out because the overall market bothered me. Now, if I was looking at, say, AMD on this move off of 50 and moving back up to this resistance area, I would absolutely be tempted to just take some money, because you can see we've had multiple failures at this level. Who's to say we're not going to have another one? So I think selling a portion of a position makes sense. But, it's just a trade by trade basis. I don't really have a set answer. Sometimes I'll trade half. Sometimes I'll trade it all. Sometimes I let it go. If I'm in a great area of the market, like software stocks, a lot of times I don't sell when I get to resistance. I actually believe we're going to go higher. So it depends on market conditions. It depends on the area you're trading. It depends on volume trends. It depends on a lot of different things. All right. What's an appropriate process in identifying, planning, and exit from a profitable trade? Very similar question to some others that I've answered. But again, this question is asking me, it sounds like I'm already in the stock, and now how do I decide when to exit? And because they're asking about a profitable trade. So they're already in, they're making money, and now they're trying to figure out a trade or an exit strategy. I think at that point, it should have already been determined. I think when you're getting in, now sometimes my exit strategy will change. For instance, I get in, I'm not too sure about the market, or maybe I'm not too sure about an industry group, but I really like the stock. Maybe it's a leading stock in a so-so industry group. And then the stock makes the move I expect, goes right up to resistance. We can use AMD as an example. So we go right up to that 57.5 level. But when we get there, I look and semiconductors have broken out. And so now I'm really bullish semiconductors. So am I going to sell? I certainly am not going to sell all of it. That might suggest that I hold on to the stock and see if I can get that breakout. So lots of different factors go into that. All right, what is your strategy in using PPOs and the 20-day moving average? Well, this is a big part of my strategy. So for instance, let's go into the Strong Earnings ChartList. Sorry. All right, so this first example is perfect, Fastenal. So when I see a stock that's going up and you see the PPO go positive, it's pointing up. You can see as the PPO rises, what this tells you is that your short-term moving average is pulling away from your long-term moving average. Your momentum is accelerating. Your bullish momentum is accelerating. When I have bullish momentum that is accelerating and I pull back to that 20-day moving average, or you can even see when you get close to this 20-day moving average, buyers come back in and you keep stepping it up. Now, when we got over to here, I would be a little bit more concerned because as we made this move up, you can see we didn't quite set a new PPO high. So now it's telling me that some of that short-term bullish price momentum is maybe beginning to wane a little bit. And going back down, losing the 20-day, I mean, you know, you're seeing more sideways consolidation. And then finally here we got another breakout. Now, the PPO turned back up again on this. So I would expect this rising 20-day to hold. Now, Fastenal, I'm not sure when they report earnings, so you want to check that out, but probably coming up pretty soon. But, you know, notwithstanding earnings, I would expect when the PPO starts to turn back up again and hits that 20-day for it to bounce off of it. And then the only exception I would say, again, is when you start to see negative divergences. And I'm going to see if I can find a really good one example here. All right, this is a perfect example. So Martin Transport, see how it's moving up? See how the PPO keeps going up? And every one of these pullbacks basically to the 20-day moving average is a great opportunity to buy. Well, notice what happens on this high. This high, we had a negative divergence, and then we got a reversing candle on top of it. That is a dark cloud cover candle, this red-filled candle. It's not quite bearish engulfing. But if you come up just short of being a bearish engulfing candle, you're a dark cloud cover candle. So that reversing candle with a negative divergence would tell me to sell. I would sell that day at the close. And normally when you see negative divergence, instead of the 20-period moving average holding, I look for a trip back down to the 50, and that's exactly what we got here. We didn't go down there until that negative divergence showed up with that reversing candle. Now, the PPO went back close to the center line, and it's starting to rise again on the breakout. So do you see the difference there? Hopefully that helps to clarify a little bit how I use the PPO and the moving averages. What do you look for in a pullback in order to make the decision to buy? 20-day test. Sometimes an RSI, I'm going to go ahead and get rid of the accumulation distribution and put in an RSI. Because a lot of times I like the RSI coming down below 50 in the 40 to 50 range is usually a much better time to buy a stock that's uptrending. So let's pull the RSI up on this stock. So this is MRTN. Here, when we got down to the 50-day, look at the RSI. RSI was back in that 40 to 50 range. So if I had run the scan that we have over at Earnings Beats, here's the 40, here's my scan for RSI 40 to 50 test. This, if I had run it this day, MRTN would have come up on the scan if I had run it against the Strong Earnings ChartList. So that's the beauty of running the scan, is I would have been told, or at least I'd have had an opportunity for the scan to point this out to me right as it was hitting its 50-day moving average. So these scans and these chart lists are a powerful combination. Question, do I use patterns besides channels? I use patterns all the time. Now, I don't annotate patterns for the most part onto the Strong Earnings chart list. What I am doing, I said, the most important thing to me is price support and price resistance. I normally, when I'm annotating these charts, is I'm going back and looking for key areas of price support at the time that they're added to the Strong Earnings chart list. Okay. But I mean, I'm constantly talking about patterns a lot of times with, candlestick patterns for sure. You know, whether it's a island reversal, island cluster reversal, dojis, hammers, you know, those are 1 day candlestick patterns. You know, as I mentioned, you know, you can get like a reversing candle, like a dark cloud cover candle on this Martin transport chart. And then, you know, ascending triangles, symmetrical triangles. A lot of times I'll annotate those either on charts on the DMR, maybe in the Earnings Beats Digest, in blog articles, on my shows. But yeah, I follow a lot of the different patterns. Love the head and shoulders, inverse head and shoulders, reverse head and shoulders, cup with handle, you know, all of those different patterns. The big advantage with using patterns is they provide you targets, whereas not using a pattern, a lot of times you're using just pure price support, price resistance. All right, just a few more questions here. Historical tendencies. This was an interesting question. I'm just going to pull up the S&P 500. All right, so historical tendencies. You've indicated that the worst time of the year is from July 17th through September 27th. Should we exit all long positions during this period? My short answer is no. That is not what I do, and that's not what I use it for. We're in a secular bull market, so I'm pretty bullish about the overall market going higher. When I say that the period July 17th to September 27th is the worst period of the year, historically, that is a fact, but it's a fact based on the last 70 years. It's not a fact that the market goes down every year during this period. Many years it goes up, and we're in a secular bull market, which to me is the most important factor. Now, having said that, I am aware that July 17th to September 27th is a bad period. And so if the market starts showing characteristics of sideways consolidating as opposed to uptrending, that will begin to change some of my strategies. I'm not going to hold as long. I'm going to be very much quicker on the trigger to take my profits when I hit targets, because if the overall market's not breaking out and trending higher, a lot of the individual stocks will fail at resistance, and also be very frustrating back and forth. I don't want to ride them up and down for 2 months. So I'm aware of that tendency, but no, I'm not going to use that as my primary reason to make a sale in the stock market. Next question. If the secular bull market thesis plays out over the next decade, which stocks would be solid investments to simply hold throughout this period? I have no answers for this one. That's a real hard question to answer. And first of all, what we do at Earnings Beats, we're always constantly adjusting. I want my money to work for me. I don't want to just buy a stock and put it away for 10 years. I mean, if I knew which one it was going to be, then yeah, that would make life a lot easier. But we don't know which one it's going to be. You know, I think if I had to buy now and 10 years from now, I couldn't look at the market and I just had to wake up 10 years from now and I wanted to be part of this, I'd probably buy an ETF, to be honest. Because things change with companies. I mean, there are great companies right now, especially coming out of the pandemic. You've got companies like Zoom. I mean, in this environment, it is a great company. But who's to say that in 3 to 6 months, Apple doesn't decide, hey, I want to get in that business. And we've got our own, you know, Zoom product that's better than Zoom. You know, and all of a sudden you've got a great company in Zoom that gets swallowed up by a great big competitor, or maybe something goes wrong with Zoom. You know, they had security flaws, maybe, you know, more security flaws surface and you know, it's just really hard to pick a company today that's going to be good 10 years from now. So I think the best way is with an ETF. If you're going to pick individual stocks, I think you got to go with the stocks that have been there, done that for a long time. So I think you're looking at companies like Apple and Amazon, you know, maybe a little bit more aggressive with maybe a Netflix, Tesla. You know, I'd even throw some of the old guard in there. I mean, Walt Disney is a great company. It's got a lot of problems right now with their theme parks and the pandemics and so forth, but you know, it's another great company. I'd have to be looking at something like that if I was going to wear blinders and not look at the market for 10 years. All right, 2 more questions. For breakouts, should a stock close at a new high or just hit a new high? Well, for me, a breakout, you got to close. You got to close. You have to understand the way the market works. If you've got a stock, and I'm trying to think of a good one where there's been a recent failed breakout. I don't know if any of the cruise lines maybe might show something, or the airlines. I'm not really seeing one there. Although, I mean, technically, I mean, you look at this is an intraday. I mean, obviously you got a lot of closing highs above this. But I think it was honestly, I think that this was an opportunity for market makers to get a lot of institutions out of stocks that are going to struggle for the next year. I think cruise lines fit this category. I think airlines, hotels. I think we had some temporary breakouts. Market's going higher. What's going on with these stocks? Royal Caribbean was up at 75. It's now back at 50. It's lost a third in the last month while the market keeps going up. So I think that this was an opportunity. You know, as we were breaking out, a lot of retail traders were getting in these stocks. I think that it was an opportunity for institutions basically to get out of their positions. And that's what market makers do. They're I'm trying to think of the right word. They are responsible, not really responsible. Well, I'll just say responsible. They have to answer to the institutions. That's where they get a lot of their business. They've got an obligation to institutions to get the best price they can for them, whether they're buying or whether they're selling. And if you've got an institution that wants to get out of 1 million shares of Royal Caribbean, this would have been a really good time to do it on this breakout. So as a lot of retail traders were jumping in, I believe that there were institutions selling. And now you can see we're starting to roll back over again. You know, if we can stay above the 20, which can stay above the 50, then maybe. But right now we're below that 20. I think you got to be careful. So, but I still haven't really addressed that question. For breakouts, should a stock close at a new high or just hit a new high? Gosh, I know I've had some recent stocks that have looked like they were breaking. Actually, REGN was one, Regeneron. So Regeneron, see this right here? I think that high close was 643. And then if we go back, and that would have been July, see, today's the 10th, 9th, 8th, 7th. Let's just run this chart through July 7th. So I'll show you what this looked like at the end on July 7th. Okay, so if we looked at this chart on July 7th, and I'm going to just maybe make this, I just want a shorter chart. So let's go with just the last few months. Just so you can see this candle really clearly. Okay, so here's an example of a breakout. REGN goes up, breaks out above 643, which is the prior candle body. I use candle bodies, the highest candle body. The candle body is this rectangle. That little, what they call tail or wick coming out of it, think like a candlestick with a wick coming out the top. That measures, that goes all the way up to the intraday high. The rectangle measures from open to close. If it's a hollow candle, then the open is at the bottom, close is at the top. So that was close at 643.92 that day. If you got a filled candle, its top is the open, the bottom is the close, okay? So anyway, 643.92 was the breakout. Do you see this day? We got up to 644.70. Didn't hold it. went all the way back down to the 20-day. So if you said, hey, this is a breakout, I'm buying it, got through 643.92, that day you've been very, very upset when it was back to 605. Now, we still haven't gotten a close. I think we have opened above a couple of times, but we keep reversing back. But this particular day, I would have sold as a short-term trader. I would have sold because here is your breakout above that 643 level, got up to 650 and change. We came back down, failed to hold it. That to me is a false breakdown or breakout, but it's also a stock that I love. This is a stock in our model portfolio. So I would be looking to sell as a trader, but as a investor, I would still be fine with it. So it does make a difference. All right, last question is, are there instances where you would chase a breakout gap? And I wrote an article, so I'm not going to spend a lot of time. I'm just going to point you to this article. If you go into my Trading Places blog today, I wrote this blog article from the mailbag. When should I chase a gap and when should I wait for a gap fill? And so I would suggest that you go in and you read this article, published today, July 10th, earlier this morning, and you can see I gave two examples. So here is Datadog, DDOG, where you gap up and you keep going up. When you gap up and you keep going up on massive volume, normally the top of gap support holds. And it did perfectly in this example. When you look at another stock like GW Pharmaceuticals, look at this gap up. The big difference is in this gap up, we didn't keep going up. That was the high of the day, was the open. That's when you normally see a gap fill. And so I would not be, so when you first see a gap up at 9:30 in the morning, you don't know. I would not be a buyer at the open. You don't know. If it starts pulling back, then you can look for gap support and the 20-day moving average. That's what I would look for. If it keeps going higher, then you've got to wait. You got to be patient. I don't want to chase. If I saw this going higher and I jumped in at 70, next day or 2 days later, it would have been back at 62. And that's what drives you crazy. You know, you chase and then you watch it go right back down to top of gap support. So I watch it and I say, okay, this is a really strong one. If it gets back down to 62, I want to buy it. Well, had a couple of opportunities there. That's the difference. And again, you can read about that in that article. So that's going to be a wrap for today. Again, we didn't take individual questions today. We had our members sending in questions through a survey that we sent out. If you're not a member of Earnings Beats and you would like to be a member, I encourage you. We have a 30-day, $7 30-day trial, and it's fully refundable. So I think if you go into the About Us, maybe you can get to it there on the join. Probably also, let me see here. All right, so if I just go into the home page, so if you're a non-member, you can just come over here and click on this join today. That's the easiest way. And you can also check out these portfolios. You know, we're really proud of what we've done here, and it's really just using relative strength, leading stocks and leading industry groups, just letting your money work for you. Yes, it'll be volatile from time to time. If you don't have the stomach for it, then I would probably stick with ETFs, you know, to benefit from what I think is going to be a very bullish market going forward. But if you're willing to take some additional risk, you know, maybe you get into the ETFs, half of it, and, you know, maybe some of these other portfolio stocks, the other half, or maybe it's 70% ETF and 30%, whatever is comfortable for each individual. But you can see the results have been pretty spectacular. And I do think we're going to be in a very strong market for a long time. With pullbacks along the way, there's going to be scares, just like we've had this year, just like we had in the trade war, end of 2018, a few times during 2019. But anyhow, if you are new to us, check us out. Join today. You'll get that $7 refunded to you. So actually, over 30 days, it's $0. The only thing I would suggest is if you're not also a member at Stock Charts, well, I get nothing out of you joining. We as a company get nothing out of you joining Stock Charts. No financial, nothing comes to us. But this is how I trade. I use Stock Charts, and our service uses Stock Charts. And so if you really want to get the most out of our service, sign up. They have a 30-day free trial. Make sure that you're at least an extra member when you sign up. And then you'll literally, once you become a member with us, you can go right into that, signed out. You can go right into that ChartList page and download our chart list right into your account. It's so easy. Click on this link and then type in this password. And then you'll have a couple of quick options on downloading into your chart list. I mean, it's such a cool feature. But anyway, yeah, check that out. All right, that is it for me, John. So I don't know if you have anything to add.
Nope. No, we'll let people know when the recording's ready.
All right, I hope you enjoyed it, and send us some feedback. Send us, members and non-members, send us something to support at Earnings Beats. Let us know what you thought of this and whether or not this is something that, you thought you found useful, and if it's something that you want us to continue going down the road. And with that, I'm going to check out. Everybody have a great day, happy trading, and have a great weekend, everybody.